Hey guys, Jay here. This is smarthelping.com. I got a brand new financial model template for you. We are going to look at on-demand mobile car washing and car detailing services. Um, this is a full financial model, connected financial statements, discounted cash flow analysis, all sorts of things. I want to start with talking about what the business is, and then we're going to look at how we ramp it up with all these different assumptions. So mobile car washing, you'd start in an area, you have to purchase or lease some vans, fit them for your cleaning services, hire some detailers and car washers, and then you got to get clients. Um, you take those vans, they go to the client's house, they wash their car, detail it, whatever they need, and then you get a one-time fee. So that's the general business model. Now let's talk about how we can do some financial planning for that. And within this template, I'll go through all the yellow tabs are input tabs where you're going to be inputting data, all in all the yellow cells. Everything else is a summary information, automated reporting, and calculations based on as we change these assumptions. Also, to make it a little easier for you guys to see what happens when you do change an assumption, you'll probably spend most of the time on the ramping tab. um, I put the full financial summary here, including minimum cash required and IRR, so you can see all the different high-level financials that change as you change the inputs. For example, if I'm in region 3 and I change my van cost instead of 250,000 a van, maybe it's 100,000, you'll see the min cash required is going to go down. My capex is going to go down. So let's see, we had 7.4 million required. Capex for year one is 4.5. Now it's 4.4, 3.9. So all of this is all live and connected. Let's talk about the assumptions though. So uh, to start the model off, you just on the global control, you can put in the max forecast length up to 120 months. Decide if you want to choose the exit or not, and if so, you could do a trailing 12-month EBITDA multiple, and that will get your exit value. This is first month of forecast is just a display thing, so you can put whatever month here. It'll just display at the top of the forecast periods, but it's not going to drive anything else. So it's not going to break the model if you change this. Also, one new thing on the terminal value, I now have it so on exit you've got the EBITDA multiple, and we've also can show the book value of the vans, since that's a big part of the business, and you might want to assume you're going to sell them at a discount or a premium or for par value of what the book value of the vans are at exit. So that's another. I've basically made the capex in financial statement connections a lot more simple and less easy, more difficult to break, basically. So this is a new style with the template that I like. Okay, so ramping. This is your first main tab that you're going to be driving assumptions. We have three regions, and these could be regions. They could be, the same region, and maybe you have different van types or different vans that do different services. But you can configure these however you want. So in this section, you can define how many new vans of each type you're adding to your fleet each month. Uh, very flexible here. You could do any kind of ramping schedule you want, or fast or slow or however. And as you add new vans, that's going to affect revenues. For example, here you can see revenue in year one is 3.1 million. If I were to add 10 vans in month one, it doubles to 6.4. So as you change these, you'll see how the financials change live right over here. So you could adjust this. Um, this is just going to count the total vans added over time. And then let's look at the configuration. So we have our three types of configurations here: region 1, region 2, region 3, or whatever you label these. And our first set of assumptions is we want to know how much are you going to charge on average per wash or per service performed. And the easiest way to model this is you have, I did up to 11 different types of packages that you might be selling, and each package has a price. And then here you're just putting the average percentage of customers that pick a given option. And then we do a weighted average price here, and this 573 says on average, based on these inputs here, every time you provide a service from van type in region 1, you're collecting $573 on the top line. Now, I've also got some inflation adjustments, pricing adjustments, so this is just, you can define the percentage increase in this price over time, which is every year. It'll go up by this percentage. Next, we have van and labor costs. So here we want to figure out, okay, what does it cost to buy a new van? So every time we put a new van in here, we got to buy it. Or if you're leasing, that's fine too. You would just zero out the cost to buy, and then you'd put in whatever it costs per month to lease a van. And this will populate based on the number of vans. So anyway, cost to buy, annual increase in cost. Again, this is an inflation factor to assume, in year 9, it might cost more to buy a van than today, whatever that cost might be. Or you can do everything nominally in today's prices and just put a 0% for the increase in prices, which will be throughout the assumptions here. Useful life, that's just for depreciation. So here we got 7 years. We're going to depreciate the vans for. That will be a direct variable cost as well. Based on the number of vans you have, the depreciation expense is going to vary, and that's a direct cost related to providing the services. So that's going to hit it's a non-cash cost of services basically. So on the income statement, that's going to hit right here in row 39. But in EBITDA, we have to add it back. So we'll add it back there. EBIT, we will include it here in our financial statements. Excuse me. So we also have detailers per van. So this is the average amount of workers you have going to provide these services. So you could adjust that. It could be 2, it could be 1, it could be 1.5 if some have 1 and some have 2. Whatever you put in here is just an average. And then based on that, you also have an annual salary for those workers, the payroll tax and benefits, fully loaded salary, and then an average increase in salary percentage. So that's a van and labor costs. We also have our variable costs, which we've did on a per van basis as well as a per wash basis. So this says every van has this amount of costs in region 1 per month. And you could define these here and say what the cost is. I also put some details here. Then we have the cost per wash. So every time a van provides a wash, which we'll discuss how the washes are defined below, but every time a wash happens, there's a cost here. I also did a processing fee, so you could define some amount of the revenue that comes from, if it comes from credit cards, you might have to pay a fee. Now, if you're including that fee in the price, then what you would do is put a 0% on the payment processing fee, and well, no, you could leave this here, but you would increase your revenue by the same percentage. Or if essentially you're going to zero it out, so you're collecting it from the customer on top of what they're paying and paying it out, you could just zero this out and don't count it here either. But in theory, it does increase the amount you're collecting from customers, but your costs will be the same. Or if there's some margin between that, again, you could adjust these prices based on what you're charging for credit card fees and adjust what your cost is here on that revenue. And let's say half your customers pay with a credit card, then if the credit card fee is 3%, but only half use it, you could put 1.5% here. The rest of these items are all cost per wash happening. We have an increase in the nominal value of these costs annually, which will apply to these, not the percentage one, obviously. Then we got to figure out, okay, well, on average, how many washes can a van do at maximum per month? And that's, based on drive times, how long a wash takes, and how many hours a day you're working, and how many working days there are in a month. So based on that, we can put in max washes per day per van, whatever that might be, and then the working days per month. And then here we can define the utilization. So if I put 20% here, that means on average I'll be doing 1.4 washes a day to start in month one. Like when a new van comes online, they might take a while to ramp up. So every van that comes on, every new van that comes on here will go through the same schedule. So they start slower, then they ramp up. And that's one reason why we have to do our matrix style modeling, because that needs to be a dynamic calculation. Anyway, so this means you start off at 1.4, then you're doing on average month 2 1.5, and so forth. Eventually you get to let's see here, 3.7 a day on average month 18. And so that's your utilization over time. Now after month 24, it goes to a yearly calculation. So you can define after the first 24 months or first 2 years, you then have a flat rate that applies to the future years from years 3 to 10 of the tenure of a given van. And that's just how much of the maximum washes per day is the van actually achieving over time. Then we have financing. So this cost up here, if you are buying the vans and owning them, you're going to have obviously maintenance and insurance, things like that. If you're leasing, then maybe you don't have insurance, but you configure this to whatever fits your situation. But if you're buying, then you're going to put the percentage of that cost that you're financing. This is not the down payment. This is essentially the loan to cost value, or LTV, loan to value. If it were 80%, that means you're going to borrow 80% and put down 20%. And you can see how that'll affect the minimum cash. So here it was 4.4 at 80. If I were only going to borrow 20%, my cash requirement is going to go up, 7.4. So $3 million more because I'm not financing. But leverage does come with debt service and risk. If you're not operating and making profits and able to pay that debt down, then that's a risk. So you can define how much of the van cost you're going to finance individually for each region, what the loan term is on that, and interest rate. And then finally, every time you get a new van, there might be some other one-off costs, branding, decals, permits, whatever, what have you. These are all deductible expenses, and they hit just immediately when a new van comes online. And they also have a subject to an annual percentage increase here. So those are the configurations for region 1. They're the same for region 2 and 3. You could put whatever numbers you want in these assumptions, but the layout is exactly the same as far as how it all works. So now we know how many vans we're going to have over time. We know how many washes we're going to perform, what we're going to charge for that, and what it's going to cost us to provide those services based on all of this. The tabs M1, 2, and 3 are just, this is how I'm doing those dynamic calculations with, the washes over time by cohort. There's the wash counts. Also figuring out depreciation and financing, principal and interest payments all has to be dynamic as well. So that's how all of this works. OpEx, this is for corporate overheads. You're obviously, if you're new in the region or area, you're going to have some sales and marketing costs, some ads, what have you. You might have sales managers trying to sign up new businesses or clients. So you have those costs to start month, the annualized cost, and then how much that increases over time. Now the first 16 slots apply this percentage. The final 16, you can manually change those, how the annualized costs change in each year if you need. G&A, same thing, but just different label of costs. Works exactly the same way. Research and development, same thing. And then here we have other catch-all costs, which will be just a percentage of total revenue. If you haven't, if you wanted to account for another essentially item that's just based on a percentage of revenues, you can put that in here. FTEs, full-time employees. So here is to separate out your corporate overhead with staffing. And here you could do different staff types. I just put all G&A, but it could be whatever um, your business requires. And you could put the start month, the count, annualized cost, and then adjustable salaries over time, as well as payroll tax and benefits. Loan 2 and Loan 3 are just simple working capital loans. You can put in a loan amount here that will flow through um, to the model based on the draw month. So if I were to put, I wanted to take out a $500,000 working capital loan and start in month 5, you can see here the cash flow statement. That 500,000 is going to hit. There's also some other lending activities going on, but it hits here in month 5, and then you'll see the principal and interest payments start to go in effect after that, the month after. I can show you on the monthly detail a little bit better. So that operating loan's right here. Here's the principal paid back on that and the interest for the operating loan 2. So we have operating loan 1 and 2, the one working capital loans I just showed you. We also have the van financing, which is dynamic based on those ramping assumptions here with the based on the cost, how much you're financing, and the terms. And then this should, for these ones, we just assume paid back at the end if there is an exit value. So this should add up to 500,000. So that's good. The calculation's working great. Okay, where were we? Loans, cap table. So this is just going to show you the minimum cash required based on all your different assumptions coming together, and the minimum, essentially, if you invest just this amount, your cash position will go to 0, but no lower. And you can see that here on the balance sheet, your cash will get to 0 there in month 27, and then we start making a profit. So this is a model that just solves for 0 cash position for equity. You can override this, or you could look at the monthly detail and just see if you wanted to manually plan it out. Here's my cash requirements. You might invest some amount here or in certain months, and you could do operating account cash flow if you want to layer that on top. But the data is there if you want to do it that way. This is just a higher level look. So this 6.9 million, so where's it coming from? Well, we have a catch-all here in row 30, that's overflow. So any money that's not put in any of these other slots will go there. In this case, I've just put founder 1 to contribute to 100,000. The rest is going to then pop into here. If this were to be more, let's say 2 million, then you can see the overflow went down. The main thing here is just the total of this section plus this section should always add up to this minimum equity required amount, whatever that is. And then the percentages, there's common, pref A and B, and really this is just going to define the total fully diluted ownership of each row or entity. And with this, again, just make sure the percentages in the top section plus the bottom section always add up to 100%. So, and this here, so if you had 10 million shares and you did 20% class A, 80%, and I'll say 70% here, and then 10% here, you still, so this is just showing how many shares are in each section, but in these, for example, here I'd want to put, okay, maybe this is a 5%, 95% situation. And then same with class B, just so you're allocating the full 100%. When we come over to the fully diluted ownership, which we see here, we are, because we got 15.5 plus 84, so we get to 100. And that's the total share count, 10 million. And that just ensures that we're distributing all of the cash requirements that are getting, are hitting for each row. Let me undo that, put it back to just the most common situation, which is everything to common, and then here's the contributions, and then this will define the distributions to each entity. Okay, startup costs, other one-time costs. This is just another place to put in maybe you don't have a good spot to put in initial expenses to get the business going. So that can hit here. It'll hit in period 0 of the model. Terminal value already went over a little bit, where we've got the trailing 12-month EBITDA, EBITDA multiple, exit valuation, book value of the vans, exit multiple on those based on the book value, and then the consideration received for the vans at exit. If you put like 0.9, you'll have a loss here. So if you look at the income statement, you see there's a loss on the vans, and that will affect essentially taxes. And then your cash flow is just whatever you're getting. So here in this case, 32 million is the amount, which is there, 32,089,000. Okay, so we have all of our assumptions we've gone through. Now if we look at the income statement, we have our 3 revenue streams from each wash type or region. Sorry, not wash type, but region. All the variable costs, so detailer salaries, payroll taxes, van lease. Here's all the costs by van and all the costs by wash, and then the initial one-time costs of getting the van going, and then depreciation down here. And like I said, this is a non-cash item, but it is considered if you're trying to calculate the gross profit margin. I think that's a relevant cost since you're directly using those vans, so the depreciation expense should be counted as a direct cost to understand the profitability better. You got your gross profit margin. Up here I did month over month growth, looking at the previous month of the same, or the last year versus the same month last year versus this month this year. So that's a little bit of a different calculation. I think that's better. We've also got operating expenses. This is your overheads. Then we have EBITDA, EBIT, depreciation. And remember, this is now, that's counted here. So when we look at our taxable income, we are doing EBITDA, not EBIT. So EBITDA is adding back this cost, depreciation expense. So EBITDA, but then we do have to take out the depreciation to figure out what's taxable, because the depreciation expense is tax deductible. And then we'll have taxes and net income calculated accordingly. And remember, the net income should equal the total cash at the end. So here's 1.732. If I look at my cash flow, 1.732. Now, because of how the depreciation and capex are offset, you won't see the same profit each period as cash flow, but that's a good check to show you kind of how the net income works in relative to the cash flow. Balance sheet, we got cash, your vans is your asset, accumulated depreciation, total assets. Then we've got liabilities, which is all our debt, equity invested, retained earnings, owner's equity, and then the owner's equity plus liabilities always should equal your total assets. And they do, thank goodness. Everything all lines up and we balanced out. Here's a balance sheet annual, cash flow statement monthly. This is kind of like uses and sources. Cash flow statement annual. This kind of cash flow analysis of the project. So here's the project as a whole, and then we also broke out the investor group and owner group based on what cap table numbers you've put into each one. So investors would be the top section, owners or operators would be the bottom section, and they have their own discount rate you can apply, get a net present value, an IRR, and then their relevant cash flows per period. This is probably the best source you would use if you're going to plug this into like a waterfall. If you're doing a joint venture waterfall with hurdles and things, this is a good, I usually always use this tab to extend these models when people do want to do like funds, or not necessarily fund, but maybe a independent GP is raising money from some investors and they want to do waterfall. This is a good view to start with as your top line cash required up front, and then potential distributions. Visualizations, we got revenue, gross profit not including depreciation. So actually cash, gross profit cash, EBITDA, gross profit margin, cash flow, annual revenue by region, EBITDA percentage, average utilization rate combined. So this is that ramping of utilization over time. Average monthly washes per van per region. Max washes versus actual washes. So this margin is just your essentially downtime of the vans. Annual capex, van purchases, total assets versus liabilities, monthly cumulative cash flow, total assets versus liabilities. And then here's average utilization over van tenure by region. This is actually just targeting the tenure schedules themselves. This percentage, where is it? This one here is doing an aggregate average of all the vans every year, and this is based on, some vans might be in different tenures than others. So this is looking at an overall average of all the vans, no matter what tenure they're in. This is your average utilization across the whole fleet. This is the schedule that each region is following when a new van signs up. And then I did another calculation here, average monthly EBITDA per van, which is an interesting one. Then the monthly details, where you can go if you want to see how everything's coming together, how we're figuring out the wash it revenues or service revenues for each region, some KPIs. Here's all your variable costs for each region, region 1, region 2, region 3, the variable cost summary in aggregate, gross profit. Here's your OPEX, overhead, staffing counts. Then we have other items, obviously the loans, principal payments, interest payments, debt service coverage, and then CapEx, taxes, exit proceeds, and van loan repayments. Annual details the same thing as monthly, and you can click up the top left here and minimize so you just see high level views here, so it's less cumbersome to scroll through if you just want to see some high level. Same with the monthly, and then if you want to expand a section, you could. Let me unexpand or expand all those out, and that's the whole model. I think it's a super detailed, very flexible model. Every single time I make a new one, I think they get better and better. So this model, I'm gonna try something different as far as how you download it and the pricing. Normally, so if you go to the link in the YouTube box below, it'll take you to the purchase page. You can buy it, download it, and use it. It's fully editable and unlocked. I think I'm going to price it a little bit higher this one. Well, you can see when you go to the page, it could vary over time, but I'm only going to include it in one bundle on the site. So if you go over to smarthelping.com, let me go over here. Um, it's not going to be in a general industry model bundle or SaaS real estate. I will put it in the super smart bundle though, so you can get it, within this for $4.99, or I'm going to put it in. Let me think. Probably a general industry section, but it's not included in the bundle. So maybe I'll put it maybe at the bottom here and say not included in the bundle, but it's still like part of, like it'd be considered a general industry specific model. It's just not included in any bundles except for the super smart bundle. Okay, so got that out of the way. You can hire me for $2.75 an hour if you want me to build do custom work. If you buy templates and want them adjusted or what have you, or want to walk through a template and try to see how it fits your own situation. I do all of that kind of consulting, financial modeling, consulting work. You can purchase time. What else do we got here? If you just want to browse, check out the financial models tab at the top. I've got hundreds of bottom-up financial models of all kinds of different industries. So that should be if you're in private equity or just looking to start different businesses and want to understand some approaches to look at financial planning, this is a really great place to start. So check it out. There's a lot of stuff here I've built over the past decade in spreadsheets, and I'll keep building. All right, like and subscribe, and I'll see you on the next one.